Imagine walking into a bank and asking for a simple financial product. Maybe it is a credit card, maybe it is a loan, maybe it is a mortgage. Before anything happens, someone asks you one question. How much money do you make? Most people answer without thinking. They type in their salary. They upload documents. They explain their job. They reveal one of the most personal details about their financial life. But have you ever stopped and wondered why? Why does a company that already makes billions of dollars care so much about your paycheck? The obvious answer is that they want to know if you can repay what you borrow. And that is true. But there is another side most people never consider. Your income is not just information. It is a signal. It tells banks how they should see you, what products they can sell you, how much they believe you can handle, and how much profit they might make from your financial decisions. Because in the modern financial world, money is not only about what you have, it is about what your behavior reveals. And this is where many people misunderstand the relationship between banks and their customers. They think the bank is simply asking, can this person afford this? But the bank is also thinking, how can this person fit into our system? Because your income can determine the type of financial opportunities placed in front of you. And sometimes, the biggest financial mistakes people make begin with accepting opportunities they were never truly ready for. A few years ago, imagine someone named Daniel. Daniel was doing what millions of Americans do. He worked hard, built a career, and finally reached a point where his income increased. After years of earning a modest salary, he received a promotion. His paycheck grew, and for the first time, he felt like he had made it. Then the offers started coming. A new credit card with a higher limit, a bigger car loan, a larger apartment, more expensive subscriptions. Financial companies suddenly seemed more interested in him. The reason was simple. A person with a higher income represents more possibilities. But Daniel made a mistake that many people make. He confused access with affordability. Just because someone gives you access to more money does not mean you became wealthier. A higher income can create more opportunities, but without financial discipline, it can also create a more expensive lifestyle. This is one of the biggest psychological traps in personal finance. People think wealth begins when their income increases. But wealth actually begins when the gap between income and spending increases. A person earning $150,000 per year who spends everything may be financially weaker than someone earning $60,000 who consistently saves and invests. The number on the paycheck is only one part of the story. What most people fail to realize is that banks are businesses. They're not designed around your dreams. When a bank asks about your income, they are collecting information that helps them understand your financial profile. Your income can influence decisions like how much credit you qualify for, what type of loans you can access, what interest rates you may receive, which products they recommend. This does not mean banks are doing something wrong. Financial institutions need information to make decisions. A lender taking a risk needs to understand the person they are lending to. But the important lesson is this. Never confuse a bank's approval with your own financial success. A bank saying yes does not automatically mean something is a good decision. Sometimes approval is simply an invitation to take on more responsibility. This connects to a major idea in behavioral finance. Humans are heavily influenced by external signals. We often use other people's reactions to judge our own success. If a bank approves us for a large loan, we feel validated. If a company increases our credit limit, we feel richer. If we qualify for a luxury purchase, we feel like we earned it. But those feelings can be misleading. A credit limit is not wealth. A loan approval is not wealth. A high income is not wealth. Wealth is what remains after your financial decisions are complete. It is the assets you own, the investments you build, the freedom you create, the options you have. This is why many financially successful people think differently. They understand that every financial decision has two parts, the visible part and the invisible part. The visible part is what people see, the new car, the expensive house, the designer items, the lifestyle. The invisible part is what people do not see, the savings account, the investments, the emergency fund, the financial security. Many people spend money trying to create the appearance of wealth, but wealthy people often focus on building the foundation of wealth. Because appearances create attention, assets create freedom. Now, this does not mean you should avoid banks or never share your income. There are situations where sharing income is necessary. Applying for a mortgage, getting approved for certain financial services, or proving your ability to repay a loan often requires financial information. The lesson is not banks are your enemy. The lesson is understand the game. Know why information is being requested. Know what decisions are being influenced. And never allow someone else's evaluation of your money to become your definition of your financial ability. Well, the deeper problem goes beyond banks. It is about how society teaches people to think about money. Many people believe the path to wealth looks like this: earn more money, spend more money, upgrade your lifestyle, repeat. But that cycle can keep people trapped because every income increase creates a new temptation. A bigger paycheck can create a bigger lifestyle. A bigger lifestyle can create bigger obligations. And bigger obligations can reduce freedom. This is called lifestyle inflation. It is one of the quietest wealth killers because it does not feel like a problem. It feels like progress. You get a raise, you celebrate, you upgrade. You tell yourself you deserve it, and sometimes you do. But if every increase disappears into new expenses, your financial position has not actually improved. Your income grew, but your freedom stayed the same. The numbers reveal something important about wealth creation. Long-term wealth is usually built through consistency, not dramatic moments. Many financially independent people did not become successful because of one massive financial decision. They built systems. They saved regularly. They invested consistently. They avoided unnecessary debt. They allowed time to multiply their decisions. This is why two people with similar incomes can end up in completely different financial situations years later. One person sees extra money as a reason to increase spending. The other sees extra money as a tool to buy future freedom. The difference is not always income. The difference is mindset. So when a bank asks about your income, remember what that number really represents. It represents your earning ability today, but it does not represent your intelligence. It does not represent your discipline. It does not represent your future. A person earning a large salary can still make poor decisions. A person earning a smaller salary can build an incredible financial foundation. Money is not only a mathematical game, it is a psychological game, and the person who understands their own behavior often has an advantage over the person who only focuses on numbers. And the person who understands their own behavior often has an advantage over the person who only focuses on numbers. The biggest financial shift happens when you stop asking, "How much money can I get access to?" and start asking, "How much freedom can I build?" Because banks may measure your income, companies may measure your spending power, society may measure your lifestyle, but your future is built by the choices you make when nobody is watching. The goal is not to look wealthy. The goal is to become financially powerful. Because the person with the highest income is not always the person with the most control. The person with the most control is the person who owns their decisions. And that is the difference between having money and building wealth.